Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
Will.
Brian here.
So today's topic, guys, we have to talk about the Fannie and Freddie fees. The government report card is now all Fs. Fannie, Freddie fees, all Fs. So let's get into it, guys.
This is just great. We keep getting more and more, you know? It's like, what else is going to go up? Or what else are we going to pay more?
Episode of the mess in the economy and the Fed.
Yeah, if the sarcasm isn't thick enough yet, guys, no one here at this table is happy about this. And so we're going to talk about it today.
Yeah.
We have to, again, this is another thing where we have to let's talk about what's actually happening. This is not good for most people, but we have to at least address it. Let's discuss it. Let's talk about some opinions and perspective. Who wants to start with what is it?
Jeez. LLPA. What does that acronym stand for there, Brian?
Loan level price adjustments.
Jesus.
That's right. So, loan level price adjustments are coming, everyone. Actually, no, they already took effect on May 1st.
Yeah.
Shoot. Yeah, so we're already a couple days into it. Loan level price adjustments are basically price adjustments to deliver the loans to Fannie and Freddie that are imposed on borrowers. The banks do not absorb these fees. That's the first thing you need to know, is these price adjustments will adversely affect people with better credit as of May 1st, just a few days ago.
Essentially, what's going to happen is that if you have good credit and you have a sizable down payment, you're actually going to get, a lot higher fees to be able to, get your mortgage.
That's
Opposed to those that have low credit, minimal funds for the down payment, it looks like they're getting a discount.
Yep.
So I'm excited to get into that.
So now let's be clear that every single loan that gets delivered to Fannie Mae or Freddie Mac does come with fees. So this isn't like,
absolutely.
some people are paying fees and some people are not.
No.
It's not like that. It's just that they recalibrated the chart based on credit score and down payment amount.
That's right.
So if you have a higher than 680 credit score, the fee to deliver your loan is now higher than it was. And if you have a 680 credit score or below, the fee to deliver your loan is now lower than it used to be.
So
Yeah, that's
an article
crazy.
that I read said under the revised LLPA pricing structure, a home buyer with 740 FICO credit score and a 15 to 20% will face a 1% surcharge, which is an increase of maybe 0.75%.
Wait, what was the credit score you said? 720?
740.
740, okay.
With 15 to 20%. And
That's crazy.
they're going to face a 1% surcharge that will increase 7.5% compared to 2.5%, which what it was before.
Wow. Yeah. Oh, yeah. I see what you're saying. So from a 0.25% to 1% fee.
That's crazy.
So let's get this clear. 15 to 20% down with a 740 credit score. It used to be a charge to deliver the loan to Fannie Freddie. The charge was 0.25%. Now the charge is 1%.
Yes. So when absorbed into a mortgage, it's slightly less than a 0.25 percentage point, and then on a $400,000.
But is that on average? That's the average, isn't it?
Yeah, more or less. And this is based off the information
Wow.
I got from
Well,
that
that one
article
is.
on the New York Post. But on a $400,000 loan, 6% origination rate, the buyer can expect their payment to rise by 40%.
Yeah, I'm looking at
Wow.
this.
$40. I'm sorry,
I was going to say
40%. That's a lot.
$40. I'm looking at this right now. Even at a 700 credit score, the fee that was 1% is now at 1.5%.
Yeah. So
Wow.
it's
1.5.
up.
That 1.5.
Now, comparatively, let's say, let's go to 640. So at 640, someone had at a 640 credit score and 15 to 20% down, it was a 3.25% cost to deliver that loan.
Yes.
3.25%. That has now been reduced to 2.5%. So that is a 75 basis points for the better.
Yes.
For a 640 credit score. Okay, so this took
Are we
effect May 1st.
reverse engineering this? This
Yeah.
is crazy.
I've seen nothing but people livid about this. Is there other stuff out there that I'm missing, or are you guys just seeing the same? Everyone's just mad.
It's just, I don't know if I want to say mad. This is just disappointing, right?
Okay, yeah,
Are
good.
we really going in the right direction here? With everything else that just keeps going up, like our gas, our utility bills, and all that stuff, do we keep adding to this? Are we trying to discourage people to do these things? I mean, we're encouraging the people with the lower credit scores and discouraging the people that, hey, you know what? I'm paying my stuff on time. My credit matters, right? And so therefore, I get penalized for that? It kind of makes you feel in that disappointment.
That's crazy. It's just... I don't know.
Yeah.
I've been trying to think, in getting prepared for today's show, I was thinking, where else is this happening? Is this happening in other areas of credit life? And I don't know because I don't know.
Yeah.
Is it happening in car loans right now? Is this happening in personal lines of credit, like everything we know that is weighted with credit, it has a tiered system of cost connected to the credit worthiness and the trustworthiness of the borrower.
Well, hopefully it doesn't stick around. You know what I mean? Because
I would
of
love
all
that.
the resistance and upsetness from people,
Industry
they're
pressure
getting
even.
like, we don't want this. This is no good.
I
like,
just feel it's
get out of here.
Like it's a fee just to be able to get more, more money flowing their way, and in
course.
reality, it doesn't really.
But it's like the same amount of money. It's just where it's coming from.
I just don't like if we start having all these, lower approved borrowers start getting into the market. They already show that they have a bad history of being, responsible with their finances. So it's like setting them up for failure if they don't already have the habits behind,
so
what they
crazy.
got to do in order to keep that house, right? So you're
Great point.
rewarding them for paying their bills not on time, and people that strive their whole life to get a perfect credit profile, to work on their finances and help their family get to a better position. You're telling me that they just did that for, just to help the people that don't.
Now, I could see where on the lower credit tiers you reduce the fee to help people have a lower cost of home acquisition and home ownership. I understand that.
Yeah.
What I don't understand is taking that reduced fee on the lower end of the credit scale and tacking that on to the higher end of the credit scale.
Yeah.
That does not make sense to me. So I guess the way I'm just describing this is I'm one-sided about it is, go ahead and give people that may have lower credit score a reduced cost to have their mortgage delivered to Fannie Freddie. Fine. Yeah. But why are we penalizing people that have 700, 720, 740, 780? Why are we doing that? That to me doesn't make sense.
I mean, with all of this is going on, what I'm going to simply now, it's like, Tanya, did you pay my bills or not? Now, before I'm stressed, now I'm just going to be like, well, whatever. I'll still,
She's going to be like, eat your dinner, 640.
Yeah. You know what I mean? I'm just going to be like, okay, pay, don't pay. It doesn't really matter. I'm going to get, there's a benefit to me here,
That's so funny.
No, what we're saying is, please do not misunderstand this, okay? Yeah. Keep your credit on tack.
Yes.
Okay. Do not think there's going to be a greater benefit by just reducing your credit scores by not making a bill or making your mortgage bill for that matter.
Well, no, that's a good point. It's going to hurt everyone. It's going to hurt you everywhere else. It's going to hurt you in your credit cards. Hurt you in your line of credit. It's going to hurt you in every other loan type.
Yeah.
This is not. This is a cost.
Well,
to
we know
the loan.
some people may have good credit. They just don't understand. They're just like, hey. I need this extra money. I just don't want to make that payment now.
Like this.
Please, no. We're not.
This does not put extra money in your pocket. There's going to be advocacy that says, "Oh, this keeps money in your pocket." No. This just reduces the amount that you're paying to have your loan delivered to Fannie and Freddie.
And then speaking, for other industry members, how do you explain this to your client that's worked up their whole life?
I don't know.
Like, I mean, how do they swallow that pill? Like, hey, at 740, 20% down.
Here's the other kicker with this. We run so many DU approvals, right? That's an automated underwriting system.
Yep.
Okay. We know that when you're either single, right, applying by yourself, if your credit scores are usually under 640 conventionally, it's pretty hard for that to get accepted.
Yeah.
You know what I mean? So usually we got to see like the higher credit scores, and I like to say maybe 680, but I've been seeing more 720, 740s. Yeah. And single, higher debt to income ratios, no problem. You get approved. Where I've seen 640, low debt to income ratios, and it denies it. It doesn't like it.
Wow.
So those are the things that we got to also consider. Yeah. And those are things that, they're just saying, hey, these are the new loan level price adjustments, but they don't know all the other facts that go behind that approval.
Yeah. There's a lot of more other variables.
Great.
But it doesn't really benefit you in the way that, if you still didn't pay your stuff on time, the system's going to read that.
This doesn't help people like qualify. This isn't like jumping people across the fence of home ownership.
Yeah. It's like we got to give the true facts here.
Yeah.
And that's why I like doing this, because we understand the back end of it.
Yeah.
Where the consumer doesn't understand the back of it. And they're like, well, wait a minute. It says that if I have a 640, I benefit. Yeah. Well, you have to get approved first. Too.
Yeah.
You know what I mean?
Yeah.
And the AUS system has to approve you.
Yeah.
Right? Once we get that approval, what that means is this loan gets sold off in the secondary market. Without that,
it doesn't matter. It's all for naught.
Then the rates aren't as favorable.
Nope.
So let's just consider that as well.
Right.
And
even though the cost of delivered is cheaper, the rate's still not going to be in your favor.
Exactly.
Yeah.
I think it's just a troubling time to roll this out with everything happening. Rates not stabilizing, home prices not figuring it out, and then inflation.
Yeah.
So it's like, okay, wait, let me just throw another wrench in the in the machine?
Well, I'm glad you said that. So I want to make sure before I forget that we say this is for conventional loans.
Yes.
So this is for
Absolutely.
conventional purchases,
That's
conventional rate and term refinances, and conventional cash outs. So at this time, this does not affect FHA and VA loans at this time.
That's right.
Is that correct?
So is
that's correct.
Is that a
Okay.
clear runway for FHA to make a bigger comeback into the market?
Absolutely.
With a
It
lower
might be,
fee?
but here's what I think it also sets the precedence for. It sets the precedence for the other agencies to do the same if this works out.
Oh,
because if there's not enough industry pushback and this isn't withdrawn or there's no withdrawal of this, then I think it's going to give a runway for other agencies to determine
Correct.
that they can come up with something like this too.
Yeah.
So one of the reasons why they did this, and I read it from the article on the New York Post, the FHFA official told the Post when asked, tasked with ensuring the Fannie Mae to fulfill their role in the market condition. They basically said that it's a far bigger factor in determining the finances of this condition in the U.S. housing market, meaning that, they're doing it for the housing market, but in what benefit?
Wow. I don't know, man. Sometimes I wish I took.
That's
I wish a part of the Senate there, whoever makes these decisions, it's like.
Yeah, I don't know, because on its face, it really does seem like it's just straight up a slap in the face of people who have been really diligent in their credit and their finances. I get that. I understand that. Like right away, I was like, wait a minute, what? There's no way this is real. I also understand, okay, let me take the alternative opinion real quick. I also understand that in order for there to be a Fannie and a Freddie, those things have to be funded somehow.
Yeah.
And again, my issue isn't necessarily that it has to be funded because they coexist, right? We can sell loans to Fannie and Freddie. They can back them and buy them because guess what? They exist. Mm-hmm. So they have to exist. There's a cost for them to exist. I get that. But the distribution of where the cost is now the new problem for me.
Absolutely.
So
yeah, this is just, it's just different times. You know what I mean? It's just everything just seems to, it's not normal. Like you said earlier, there's just more cost added, more cost. Guys, we still haven't forgotten that there's been a delay on the debt to income ratio.
Yeah, that's the other one that's coming up, right?
40%
That's in August.
Is that in August?
But it was supposed to already come into effect.
Right, they delayed it, right?
They delayed it because they saw that, hey, you know what? There's not much steam in the housing market. So how do we just prolong something by not adapting to it right away?
That one's interesting because obviously they know that consumers have the highest debt right now ever. And now you're saying, hey, we know this. So, hey, we're just going to penalize you even more for having more debt.
How do we set you up for?
How do you set them up for success? You're not. I don't believe so.
Yeah. Wow. So that's crazy.
So what should people do then? So let's talk about what should people do. Like we're giving this information. Someone's watching and listening to this. Like if they want to buy a house in 2023, even though we don't know, I mean, yes, the DTI thing's off in the horizon a little bit, but knowing this that we know now, what should they do?
I got it. Go join the military.
Oh my God.
Go join the military. Utilize your VA benefits.
If they're beyond service age, what should people do
like
right
my
now?
age here, they won't take me, right? Even
They
if I
won't
find
take me
myself in
either.
there.
Yeah, I got the haircut, but not the age.
There you go.
Honestly, you should probably just stop paying your bills.
No, come on. Let's give some real practical advice. Like, what can we do to help somebody right now?
If we know that the debt to income ratio fee is going to go into effect in August, then start by minimizing your debts, right? Try to pay them down. That's always just a key because obviously you don't want to be paying more in debts every month. Now, as far as the rate and the level, the loan level price adjustments, you can't really do much about that, right? So the market is going to do what the market's going to do, and we're going to hope that there's enough people that fight this back to say, hey, we don't need this in our marketplace. And I believe that heads of big banks, head of huge mortgage corporations are already sending these emails or in contact with the people that are in charge of making these things happen, saying, hey, this is at no benefit to the consumer at all. So what are we doing here? And I believe that it really just comes down to back to what we said, staying informed of what's going to happen.
That's it.
Being informed, I think, is the most important thing right now because then it's going to let you know how to pivot, how to move, how to take the right decisions. But if you're just getting the information and not taking decisions or making impulsive decisions, you're going to not reap the benefits of the opportunities.
Find a creative way how to do these things.
100%.
Honestly, I have a buyer right now, 20% down. It's a $999,000 purchase. Look at the conventional side of it. Look at the FHA.
Yeah.
I mean, either way, you gotta find a strategy how to save that consumer some money, right?
Yes, 100%.
In this case, me by switching it from conventional over to FHA, it's saving $250.
Oh wow!
Even them having mortgage insurance.
Even with mortgage insurance,
right?
Wow.
So those are all the things that you really have to look at. Is you have to find the person that's gonna be a little thinking outside the box
Yeah,
and just
that's
coming
good.
to things, right? And so, hey, I saved $250. They're going to refinance anyways out of this.
Yeah.
You know, so maybe in time, when the rates go down, we'll end up finding a different alternative.
I think even just us having the conversation is kind of like step one, like be aware.
Yeah.
So as we're
Just
telling
be
people
aware,
like what to
exactly.
plan for, like be aware of what this rule is, how it impacts you based on your credit tier, because looking backward actually doesn't change. You know,
Yeah.
the rule's already in effect. So
Yeah.
essentially being aware that it exists, number one. And number two is kind of maybe 1A or 1B is like, just understand this is going to get baked into your closing costs or your rate somehow or another. The bank will be passing this fee on to you.
Exactly.
So that might mean you have to save a little bit extra money. That might mean your
absolutely.
debt to income might need to be a little lower. You might have to pay down that credit card a little lower so the numbers work out. And then just be proactive with your loan officer.
That's it.
I think what I would say is just make sure you're talking to your loan officer and knowing exactly how this translates into affecting and impacting your loan app.
100%.
And you know, one of the big things I always like to teach is leverage, right?
Yeah.
A lot of times we have this money in our savings account. Well, guess what? If it's in our savings account, how much interest are we making on that money?
Probably zero.
Right? So sometimes
Or maybe
we
a
like
little
to
bit.
think we
A little
have
bit
that
depending
money
on
there, but we'd rather have a credit card that has a 16 to 24% interest that you're never paying down by paying down that. Sometimes it's just best, hey, let me go and tap into that savings. Let me pay that off.
Pay that off.
And
Yep.
then I'll try to replenish my savings with what I was making payments on a monthly basis, just replenish back, making payments to myself.
Yeah.
That's
You
a
know,
tip.
or you have a 401k, look into that stuff. Like,
Yeah.
hey, what can I do to borrow my own money?
Yeah.
And this is a misunderstanding that people don't understand. So if I have 100,000, I need 50,000, and they allow me to borrow that 50,000, they think, oh, I'm not making money on that. No, that's incorrect. You still make money, interest on that $100,000.
Wow.
Yeah,
And
'cause
you
you're gonna pay
borrow
all
your
that back.
money
Yeah.
at
Yeah.
a cheaper
Yeah.
rate.
Right.
Like I just did myself, 4.25%.
Yeah.
You know, why go borrow at 16 or 24 when
No.
I can borrow myself and not just
100%.
replenish the funds?
Yeah. No, I think a lot of people are
very
going to end up
smart.
having to do those kinds of things. Not just because of this fee, but also just because of the environment we're in.
Just
I think
the
the
environment,
conditions of the market are
period.
such that people, like, again, we're back to the creativity
That's
part
it.
of our conversation where it's like, this is just what it takes. And now having this rule in place, we have to get more creative or understand, okay, there's another variable on the table, another X on the mark. Now we got to figure out how to help people navigate through that.
Absolutely. And I like that word, creative.
Yeah.
We got to be creative. Everything that we're doing, it's all about creativity.
Yep. Especially
That's
right
going to
now.
win the race
Yeah.
nowadays. Those are just, we got to think outside the box.
Yeah.
100%.
And also I think, you know, kind of in wrapping this one up today, guys, like if anyone has questions more specifically about this, how this pertains to them, by the way, I should note, this does not affect you if you already have a loan. If you already have a loan, this does not
Great
affect
point.
you at all. This is only for new originations that are conventional purchase, rate and term, or cash or refinance. But I want people to understand that they can reach Brian, they can reach Will. If you have questions, you're watching, listening to this, and you need to know how to better strategize your purchase or refinance in 2023, please DM us, contact these guys directly, and let them know what your questions are.
Yeah, I'm glad you brought that up.
100%.
You know, if you already have a 2.5%, 2.25%, 3, and if you're VFA, don't worry about that. It doesn't
You're
affect
fine.
you in any
You're fine.
way.
Yep.
If somebody tells you, yep, it's going to happen to you, you have a 2.75 just to
No, it's not.
refinance you. No.
Yep. Yeah.
You
So
know,
be
you never know.
calculated and be smart about it. And you know what? I'm going to predict. This is a wild prediction. We're going to celebrate. We'll have cake on the show.
Yeah.
When they roll this back.
Exactly.
Hey!
Yay!
Oh,
You know,
and you got to wear a suit and tie.
Yeah.
Okay.
Well, here's
all right.
the-
That's
here's the
it.
thing, too, with
cake
that.
and suit and tie.
And sign the petition.
Oh,
That's
yeah.
where I'll sign a petition.
Yes,
Get rid of
yes,
this.
Yes.
thing.
Yes.
We'll put a link in the description box to sign the petition if you are
gonna be
against
singing
this
it.
new fee rule. But yes, I will agree on camera and on the mic right now.
Yes.
We will have cake and I'll wear a suit and a tie when this gets rolled back.
Let's
go.
Good show, guys.
Come
Thank
on,
you so
dude.
much.
Thank you, Andy.
This is about we, not me.
That's right. All right. Well, thank you guys for tackling this difficult topic with me today. Appreciate you guys being here, bringing your knowledge and experience. And everyone who's watching and listening, thank you so much for tuning in once again. And we'll see you again next week.